In this video, I'll be teaching you my two entry model, which is the structural liquidity and the engineer liquidity. I'll also teach you the types of liquidity and how you can use them to maximize your take profits. So if you find this video helpful, please do well to subscribe. And without much talk, let's get into the analysis. So the first entry model I have is the structural liquidity. Now the structural liquidity is a situation whereby you have a break of structure above your order block. This is simply what a structural liquidity is. You have your order block, then we have a liquidity. The market will break structure, then come and tap into your available order block before actually moving in your direction. Right? Now your expectation for the case of structural liquidity is for markets sweeping the liquidity and then tap into your available order block. So this is your order block here. You have your liquidity here, which is this low. Then you have your break of structure. All right. So this scenario is in the case of you buying the market. So this is a buy scenario. Okay, it's a buy scenario. So you have your entry from this very tip of the market. You have your stop loss a little bit below that order block, and then you target the nearest high for the case of you buying the market. Now for the case of you selling it, it's basically the opposite. You have your order block here, market pull down, and we have this first pull up that did not mitigate your order block. The market breaks structure, come back to mitigate your order block before actually dropping to the downside. So you have your order block here, which you can label as BOS, as POI. Then you have your liquidity that the market actually sweep. But before that sweep of liquidity, you have your break of structure there. Okay, have your break of structure. So this is a scenario of you selling the market. If you are shorting the market, this is a scenario of you shorting it. Now pay attention to the entry. Your entry needs to be at the very weak of that candle, either wick or body. It needs to be at the very tip of it. And I'm going to be showing you on the charts how to get different pinpoints of entry in the market. Okay, this is the case of you selling it. Now this is a sell scenario. I'm going to change this one to red because you're actually selling the market. Now these are my two. This is one of my entry model, which is the structural liquidity. Remember the expectation, market sweeping the liquidity and then tap in your available order block. Now we'll move to the second entry model that I have, which is the engineer liquidity. Now your expectation for the engineer liquidity, let me take this a little bit up. Your expectation for the engineer liquidity is market taking out the engineer liquidity above the order block before the impulsive move. Now, what is engineer liquidity? This is a situation whereby market creates a liquidity above your order block without actually breaking structure. So this is what an engineer liquidity is. You have your available order block here, have the pull up, and then you have your liquidity. But then this second pull up to the upside will not break structure, rather it will come back to mitigate this order block before going in your direction. Okay, now this is a buy scenario. It's a buy scenario. You have your liquidity here, which the market actually sweep. Have your liquidity there, which the market actually sweep. Right? I'll make it more clear, more okay. Have a liquidity there. So you are looking forward to buy the markets from here. You have your stop loss here, then you target the nearest high. Okay. Now this is for the buy scenario. This is when you are looking forward to buy the market. Change this one to blue. Now for the sell scenario is simply the opposite of it. For the sell scenario, you have your available order block, market pull down. You have a small, remember this liquidity will not mitigate our order block. The market will just come down a little bit, come back to tap in it before actually dropping to the downside. But let me take this thing closer to it so you see it clearly. Then you have your available order block here. Right? Now if you find this video helpful to this point, please do well to subscribe. Then you have your liquidity sweep right here. Okay, have your liquidity sweep there. This is a scenario of you actually selling the market. This is a sell scenario. Then you target your recent low for the case of you selling. This is sell market. Okay, so these are my two entry models. We have the structural liquidity and the engineer liquidity. So up next we'll move to the types of liquidity. So I'm going to be showing you guys the types of liquidity that we have in the market, or at least the commonly used liquidity. So the first one, we have the equal highs and low liquidity. Now for the equal highs and low liquidity, this is also known as the double top or double bottom, whereby you have one impulsive high, then a pullback, then the markets come back and create another impulsive high before actually dropping to the downside. Okay, so this can be considered to be an equal high or equal low liquidity. Excuse me, let me draw it more properly. So you have your equal highs or equal low liquidity here. Okay, we actually make this EQI or I. And then for the opposite side, you have your equal low or double bottom. Have your equal low or double bottom here. Alright. Equal low. Write it there. Equal low. Then for the other one, which is the up and down trend line liquidity. Now this up and down trend line is just basically your higher lows and higher highs, and your lower lows and higher lows. You understand? So just like a channel liquidity, just as the name implies. Now for the case of a uptrend, you have this trend line. Okay? You have this trend line. So this trend line now is actually carrying a liquidity. Okay, it's carrying a liquidity. For the case of the upside, the liquidity is right here, which means this level here. This is the area of liquidity. The liquidity is actually here. We represent the liquidity with the dollar sign. Okay, for the case of a buying market, buying market, you have the liquidity below. Turn that one to blue. Okay. Now for the case of a selling market, you have the liquidity above to be swept because the market actually needs to buy in order for it to sweep the liquidity, right? So you have the liquidity above, not below it. So right here, these are the trend line, and I'm very sure you know the reason why it's called trend line. But if you don't know the reason why it's called trend line, just as the name implies, you can see that the market is moving in a parallel motion, like in a parallel way. Okay, we have the different touch of that level. So for this scenario, the liquidity is on the upside, represented by liquidity, because the market actually needs to buy from here in order for you to take out the liquidity. Okay, so the market needs to buy from there in order for that liquidity to be taken out. Right, for the case of the this is selling market. I mean, you need to sell it. Wait, excuse me. Okay, I'm correct. For this liquidity, the market is on the downside because you need to sell it in order for you to clear the liquidity. So this is it. Then for the long weak liquidity, let me put this one sell here. Selling markets. Selling markets. Selling markets. Let me change this color to red. Okay. And then for the third one, which is the long weak liquidity. I've talked about this long weak liquidity in my recent video. Okay, it's basically whereby the market creates a big candle, and then that big candle will have a very long wick, a very long wick. So that's what is now the long wick liquidity. Excuse me, let me put this on here. You have your candle, very big candle here, and you have the wick beneath it. Okay, this one is for the long wick liquidity. And for the fair value gap, I'm very sure that if you're watching the video, you know what fair value gap is. But in case you don't know, a fair value gap is just basically the distance between three consecutive candle. What it means is that the three candle must be the same color of candle. If it is a buying candle, then the three candle should be a buying candle. So for the fair value gap, you have okay, let me see if I can use this to draw it. It's just the imbalance between candles. Okay, I have here imbalance, and then this space between the candle is actually the fair value gap. It's actually known as a fair value gap. So it has to be a fair candle sequence. Okay, so that is what is known as fair value gap. But also, if this illustration did not make you to understand it, I'll put a screenshot of it by the side so you understand it more properly. So we have our fair value gap here, FVG. So these are the types of liquidity. Next up, we are going to go over to the chart so that I can show to you guys some of these liquidities and some of this entry model so that you understand it more better. So this trade on Nasdaq, you can see that we have, let me go down to the 5 minutes time frame in order for you to actually see it well. Okay, you can see that we have an available order block here, right? Then the markets um, make an positive move to the upside. We have this pullback, but this pullback did not actually touch this order block. Rather, it broke structure. Okay, market broke structure to the upside. We have the break of structure here, right? And then what happened? Markets traded, find its way to the upside. The market act before markets actually come back to tap into this level, and then it's moving in my direction. As at the time of me recording this video, the trade was around this level, but the I don't know if there's news release, but I'm not sure if there's any news. Market just hits my TP and then this long candle. So this one is the entry model for the structure liquidity. But also, you will notice that this trade also have the trend line liquidity that we talk about. Okay, trend line liquidity that we talk about. Now, the psychology behind the trend line liquidity is for you to actually trade it to allow the market to sweep out the trend line liquidity. You saw that this market now, it came down to take out all this liquidity down to the very first point the liquidity starts to accumulate from before it starts reversing to the upside. You see, so if you are trading the trend line liquidity or any type of liquidity, your take profit should always be that the market should sweep out all the liquidity. So this is a case for the structural liquidity and also the trendline liquidity. Now, for the case of the long wick liquidity, you can see that this market creates this long wick, right? And then the next candle actually pulled up first to the upside, but because I knew that like most of the time market need to come down to fill this liquidity at least to 50% of it or very close to the ending of it before actually reversing. So I was selling Nasdaq from that point, but market took me out before actually market reversed and took me out before actually coming down massively. All right, but this is just to tell you that the each time market create a long wick like this, there's a very high chance, like 90% chance, that market is going to come down to fill that liquidity. You can see them all here to fill it at least half before reversing. And also for the double top or equal highs or equal lows liquidity, you can see that the market creates this equal highs here. Right, market create these equal highs and bring out all equal highs, and then the markets make this pull down, which is the market sold from there. And then when the market starts buying again, the market actually came to take out this equal high liquidity before reversing to the downside, right? And there are other trades, because I use mostly the structural liquidity for my entry. It's really hard for me to show you guys, especially on this video, because I do not have new entry on engineer liquidity. On my previous video before this particular one, I had an engineer liquidity entry on, I think, USD cap, something like that, right? But I do not have any recent trade on engineer liquidity because I mainly use the structural liquidity. If you check all my trades, I talked about this trade on my other video when I hit SL on it. I also hit SL on this one. But then all these trades, all these take profits, they are all structural liquidity entry model. Okay, so remember to always backtest and practice everything you learn from this video. Okay, and hopefully I think I'm thinking that I'll be buying Nasdaq more if it pass this zone here. I think I'll be just buying it more. All right, So thank you guys for watching to the very end, and please do well to subscribe to this channel.